All right, guys, so we're going to do chapter 9. I know we're back to just a regular slideshow here. That's okay. I didn't have the document camera with me to record this, and I didn't want to wait any longer than I needed to. So chapter 9 is about liabilities. Liabilities are something we've already discussed in other portions of the class. So a lot of this is just going to be review. There are a couple of things that will be new to us, a couple new types of liabilities, and a new kind of calculation, a new way to record one of those new liabilities. So first we'll talk about current liabilities. We'll hit up long-term liabilities. And then we'll talk about some new ratios. There's 5 of them. They're for liquidity and solvency. So the first thing we're going to talk about is capital structure. Now, this is something you already know about, kind of just inherently know about, but now we're putting a name to it, like we're putting a face to the name here. And this is capital structure. So it is the mixture of liabilities and stockholders' equity. So when somebody asks, what percentage of your capital is financed through debt, what percentage of your capital is financed through equity, this is what they're talking about, your capital structure. And we have 2 ways that we finance. One is going to be debt financing, which is essentially just borrowing money from creditors, or if you sell bonds, that is another type of debt financing, and that is borrowing money from lots of different people, right? A note would be borrowing money from one person, a bank. Bonds would be borrowing money from lots of different people. We also have equity financing, and this is just selling shares of ownership in our company, right? We collect the investment, we collect the capital through stockholders. We sell shares in our company. The cost, there is always a cost to financing. There's always a cost to obtaining your capital. And when we obtain capital through debt, and when we finance through debt, that expense or that cost is interest, right? So when we borrow money from the bank, when we take a loan out from the bank, the cost of borrowing that money is interest. When we sell bonds, when we issue debt in the form of bonds, the cost of that, the expense is interest. And with equity, the cost of that, the cost of giving ownership to other people, ownership of our company to other people, the cost of that is going to be dividends. Okay, so we provide them with dividend income. For that, for us, it's not an expense. Remember, we talked about way early in this semester that dividends are not an expense, right? They're a completely separate item. So we have a couple examples of debt that we can talk about. Notes and bonds are the ones we're really going to focus on in this class. We won't focus on leases so much. Just know that leases are a form of debt, but they're complicated and they are more of upper intermediate to advanced accounting topic. So if you are an accounting student, you will get to see plenty of lease accounting when you get to like accounting 302, which is intermediate 2. You'll also do some, I believe, in 504, 604, which is advanced financial accounting problems. So let's not worry about leases in this class. What we will focus on is notes and bonds. Okay, so here's just a quick review. Current liabilities. So let's talk about what is a liability. Well, a liability is just simply an obligation for us, right? For our company. We owe somebody something else. Now, sometimes that obligation is we owe somebody cash. We've got to pay them cash at some point in the future. That's going to be things like accounts payable, notes payable, salaries payable, right? But we have other types of liabilities like our deferred revenue, where we don't owe somebody cash. We owe them the performance of an obligation, right? We owe them a service. We've got to paint their house. We've got to mow their lawn. We owe them a good. We've got to get them a new copier, a new printer, a new vehicle, whatever the case is, right? So just know that with current liabilities, sometimes the obligation is cash. Sometimes the obligation is a good or a service, okay? And just recall that current liabilities are liabilities that we expect to pay within 1 year, and long-term liabilities are liabilities that we expect to pay in more than 1 year. So one of the first liabilities we'll talk about right now are notes payable. These are essentially loans you take out from the bank, right? You are generating your capital. You are financing your company through one single entity, a bank, typically, okay? So when we sign a notes payable, We are creating an obligation for ourselves, and that obligation is we are promising to repay the amount that we've borrowed. This is called the principal. So when you hear me refer to the word principal, it means the amount that you've borrowed. Okay, so if you sign a note for $100,000, the principal is $100,000. Okay, so when we sign that note, we're going to promise to repay the principal plus any stated interest on the note. So that interest is just simply the cost or the expense of borrowing money. So we're going to have interest payable and we'll have interest expense. Okay, for notes payable, we're going to pretend as though we don't pay any of this until the very end of the note. So we'll have interest payable and interest expense. Okay. Again, just a reminder, this is something that we've done since like chapter 3, chapter 4. We're going to use our ART formula, what I call the ART formula, your amount times your rate times your time. You may also see this presented as principal times rate times time. It's the same thing, okay? Now remember, typically speaking, and we'll see an example of something a little different later on in this chapter, but typically speaking, our time is going to be presented as a fraction of n over 12, where n is equal to the number of months that you have had the note outstanding in the year. So how do we record a note payable? Well, we record it by increasing the cash because we get cash, and we're going to increase a liability because now we have we've created an obligation for ourselves to pay somebody else some money. So looking at this example, it tells us that Southwest borrows $100,000 from the Bank of America. They borrow it on September 1st, 2024. This is important. Write that date down. Highlight that date, whatever you need to do, because that is an important date to know. So they sign for this note on September 1st, 2024. It's a 6% 6-month note for the amount borrowed plus any accrued interest due March 1st, 2025. Note that word as well. I would highlight the word accrued. Okay. Do not get yourself confused. This is still a 6% note. This is not a 3% note simply because you are only signing the note for 6 months. This is still a 6% note. Any interest rate that we present in this class is going to be presented as an annual interest rate. So if it says 6%, it is 6% for the entire year. So when we do our ART formula for this one, we're going to take that amount, that 100,000. Well, we'll do that on the next one. We're just going to record the principal here, okay? But just pay attention to those numbers and those dates. So on the date of issuance, on the date that we sign the note, we're going to record a $100,000 increase to our cash asset and a $100,000 increase to our notes payable liability. And we create that liability simply to remind us we owe somebody money. Okay. So when we record the note payable, we're going to have to also record interest payable at the end of the year. Okay. Because remember, we're not actually going to pay any of this interest with cash until the end of the note, until the end of the life of the note. Okay, so that's that 6 months. That's that March 1st, 2025. What we will do just for observation purposes is we're going to find out how much interest do we actually owe. Okay, so at the end of this, you can see we're going to owe $3,000. We take $100,000, our amount, times 6%, our rate, notice it's 6%, times the amount of time that we're going to have this note. 6 months is the full life of the note. So you're going to owe $3,000 in interest at the end of this note. However, remember, we're doing accrual accounting, and in accrual accounting, we record these expenses as we incur them, right? So we match our expenses to the revenues they help us generate. So borrowing this money, borrowing this $100,000 helped us generate revenue in the 4 months of 2024 that we owned it, okay? September, October, November, December. So we need to recognize that expense. Even if we're not going to pay it yet, we need to recognize that it helped us generate revenue. And that's what we're doing here. We're going to take that 100,000, again, our amount, times our rate, 6%, times the time that we've had it, 4 months out of the 12 months. That gives us $2,000, okay? So we'll record a $2,000 interest payable liability. That'll be an increase to a liability. And we're going to record a $2,000 interest expense. Okay, that's going to be an increase to an expense, which decreases your net income, which in turn decreases your retained earnings. Okay, So this would be the journal entry for it, an increase to interest expense here in the amount of $2,000, recognizing that it cost us $2,000 to generate revenue using this money in 2024. And then we're going to create this payable account to remind us that, hey, we owe somebody cash in the future. Okay. So let's record the repayment of the note. This happens at the end of the period. This happens at the end of that 6 months. Okay. So we've had that note for an additional 2 months in 2025, January and February. So we're going to find out how much cost is associated with that. How much did they charge us in those 2 months to borrow their money? And it's $1,000, the amount times the rate times the time. Okay, so we get $1,000. You'll notice that $1,000 plus the $2,000 payable equals the $3,000 of total incurred interest, what it cost us in total to borrow that money. Okay, so we will we're going to decrease our notes payable liability because we're paying it off. We're finally paying it off with cash. We no longer have that on our books. We're going to decrease the interest payable because, again, we're paying that off. We're actually paying off the cash. Notice it's for only $2,000. That's the only payable for interest we had. We're going to increase our interest expense again by $1,000 because that's what it cost us for the 2 months that we had it in 2025. That increase to expense is going to decrease net income and decrease retained earnings. And then we are going to decrease our cash asset by $103,000. Okay, and that's the total of $100,000 plus $2,000 plus $1,000, right? So highlight this part right here in your notes. This is just to remind you guys that we report the interest expense in the period in which we incurred it, right? The period in which that expense happened, the period in which that expense helped us generate revenue, okay? That's what helps us comply with our matching principle. And that matching principle simply states we match our expenses to the revenues that they helped us generate. Okay, so that's the end of video 1. We'll be back for video 2. Please contact me with any questions you have about this. These should be fairly familiar. We've done these kinds of journal entries and this kind of recording since like chapter 3 and chapter 4. If you're still having trouble with these kinds of adjustments, go back and review those chapters. It will help you.